It's only been a couple of weeks since Jackson Hole and Jerome Powell dishing out his punishment to the market. With the Dow taking a dive of over 6.5%, we seem to be seeing a turnaround. That is until last week's CPI report drove the Dow off a cliff back to the same level. It seems whenever the market sees a drop, there is an abundance of YouTubers and market experts coming out of the woodwork with yet more predictions of another market crash, with Morgan Stanley predicting a further 15 to 25% drop off the S&P 500, and Michael Burry issuing yet another one of his far too regular crash warnings. What's the count of the number of times he's actually got this wrong? Coming out with these warnings is like inciting a mob, jumping on the bandwagon of negative market sentiment to poor viewers with their shocked faces. Only for the most of these predictions to be wrong and rarely come with any practical advice. The market is a roller coaster right now and likely to continue this way for some time, so investors need to think defensively, and that's why this will be the first of several videos I'm making which will give actionable information on the investments I'm making to get through a recession. The topic I'm covering first is the oil and gas industry, and with the energy market seeing massive highs, I'll be rotating my stocks in my portfolio with a new entry of a stock that's already up 53% year to date. So it's going to be a good one. Here we go. It's not news that the Western world is facing an energy crisis, and I previously covered this back in March, outlining two undervalued oil companies that could perform well in response to the war in Ukraine. DVN offered great value because of the domestic oil production. Fuck you, Putin! And CTRA for their expanding capabilities in natural gas production. Fuck you, Putin! Both companies saw massive highs, but the industry did get ahead of itself, leading to a correction of all the major oil companies in June as oil prices have started to come down. But there are reports that the Biden administration may refill the USA's emergency oil stockpile if oil hits $80 a barrel, a move which may prevent a further drop in oil prices, with JP Morgan in an interview with Bloomberg on the 13th reiterating their forecast of $150 in 2023. And as with the hype over LNG, this has come back down due to the lack of infrastructure curtailing supplies, no thanks to Biden's anti-fossil fuel stance blocking construction projects and many LNG developers unwilling to invest in liquefaction facilities without long-term contracts with Europe. But as the energy crisis in Europe grows, Biden and the US Department of Energy have authorized additional exports to meet European demand, with companies such as Cheniere Energy reporting their 0.72 billion cubic feet of LNG per day, exceeding previous export amounts, and the US in general is the largest global exporter of LNG, with volumes expected to increase 20% by year end. That gives plenty of good reasons for developers to invest in infrastructure to meet that demand. In May, a consortium of oil and natural gas companies announced they would be moving ahead with the construction of the Matterhorn Express pipeline for transport across Texas. In addition, Energy Transfer LP, who own a large platform of crude oil and natural gas assets, are looking to build new LNG pipelines, transporting from Texas to the Gulf Coast and across the Permian Basin. Plus, they just secured a 20-year agreement with Shell, the world's largest LNG supplier, to ship 2.1 million tons of LNG per year, due to commence in 2026. XOM and Quota Petroleum are developing their $10 billion 69-mile Golden Pass LNG project, which is expected to become operational in 2024 and transport 2.5 billion cubic feet of LNG per day, giving them the keys to become the premier LNG exporter in North America. A lot of this LNG movement is fluid, as the world is adjusting to the situation in Europe, and with the possibility of a recession, you won't want to be placing bets on the benefits of infrastructure that hasn't been built yet. Instead, you need to be focused on profitable companies with low fundamentals and resilient accounts, and look no further than ExxonMobil. Here's the breakdown. ExxonMobil were formed in 1999 with the joint merger of John Rockefeller's Standard Oil and Mobil, combining 100 years of experience into one of the world's largest big oil companies in production, producing more oil and gas than any other US energy company. In their last earnings, the company reported that the pandemic exacerbated already stagnant investment into the industry, and much further financing is required to meet growing demand by 2023, and that means cash. And thanks to Exxon's high revenues and impressive profitability, they have plenty of. In fact, compared to their peers, their level of cash production is just indecent. Exxon have been putting this to use, investing $90 billion in exploration and development between 2017 and 21, with $13 billion alone in 2020, and $8 billion invested in energy products since 2017, with their latest Beaumont refinery expansion investment putting the industry to shame. It's no wonder that their compound annual growth rate doubles the industry. On top of that, Chief Executive Darren Woods laid out aggressive targets following their exit from Russia, with the company planning to cut costs by $3 billion by the end of 2023, investing in low cost of supply assets, including the Guyana and Permian Basin. Having driven the break-even cost of oil down to $41 per barrel, they aim to drive this down even further to $30. Those savings can be directed towards greater shareholder returns, adding to their dividend aristocrat status, having increased their dividend every year for 39 years, and for a stock that already trades with a yield of 3.64%, it's all good news for investors who love a dividend. The stock is up over 76% over the last 12 months and has massively outperformed the S&P 500, and why shouldn't it? Despite taking a hit in 2020 due to the pandemic and the overabundance of oil it created, the revenue and net income has recovered already, and compared to rivals, they are leading the market in terms of both. EPS has been growing rapidly too, reaching all new highs, and the company is expected to report around $3.50 per share in November, which would represent year-on-year growth of 120%. At $97, Exxon trades at a forward PE ratio of just over 9 and a PEG ratio of 1.69, along with other metrics that show the stock is at a premium compared to the industry averages, especially when compared to stocks I've covered previously, CTRA and DVN Energy. I stand by my deep dives on these good performing profitable companies with strong growth, but there is a point here, and that is resilience in a volatile market. Show me the money! And with Exxon pumped up with cash and outperforming the industry, they are already prepared for a recession and more than capable of taking advantage of rising energy demand. For that reason, I've rotated out of CTRA in exchange for Exxon and adding to my energy position with Devon. The energy crisis is going to be a major issue for the long term, and as much as the Western world wants to move into green energy, the fact is they have failed to deliver the necessary infrastructure to carry it out, and with Putin no longer a source of oil and gas, they are having to play catch up, with the threat of a recession and a volatile market making it difficult for investors to get on board, let alone stay on board. It's for that reason that we need to be a little less zealous with our stock choices and instead look for companies offering stability, not massive potential on the assumption they can develop fast enough to meet demand. The demand is here now, and it's companies with the capabilities and the capital to hand who are going to get the job done. For that reason, Exxon is an obvious choice and one I'm happy to hold in my portfolio in this market, and with their next earnings due in October and September seeing a market downturn, it's a great time to build up a position. Now that's my take, and if you have any thoughts, please comment below and let me know, and if you like what you see and you want to see more, just smash that like button and subscribe so you don't miss out. Until next time.